Our next topic is on stock transactions, but first let's discuss some key terms of stock. Authorized stock is the amount of stock shares that the company can issue or sell to the public. Issued stock are the actual shares that have been sold. For example, the company may be authorized to issue 2 million shares of stock, but they might only issue 500,000. Companies will hold on to some of their authorized stock for future ventures in case they need money to build a new factory or conduct additional research in the future. The market price of the stock is the amount that the share is currently selling for. This changes constantly as investors are continuously buying and selling shares. Share prices change because of supply and demand. If more people want to buy a stock than sell it, then the price moves up. On the other hand, if more people want to sell a stock than buy it, there would be a greater supply than demand and the price would fall. Also, economic conditions affect stock prices. For example, during the COVID crisis, many market prices fell, with only a few that went up. The par or stated value can get a little confusing. However, we will talk about this throughout the chapter, and hopefully, in a few minutes from now, it won't sound so confusing. The par or stated value is the amount assigned to each share when it's authorized or by the directors. State law dictates whether there is a par value or not. For example, in New Jersey, you don't have to have a par value on your stock, but you can if you want. This is really just the minimum price that the stock can legally be sold for. Usually the par value is very low, such as a penny or less. For example, the par value for Apple shares is 0.00015, not even a penny. And the par value for Amazon shares is 1 penny. When investing in stock, the par value makes no difference and it won't affect the market price. We bring this up though because it does make a difference in our journal entries. So accountants do need to be aware of the par or stated value. Lastly is no par stock. This is when stock is not assigned a value per share by the corporate charter. Most of our examples will have stock that has a par value, but once again, this is only relevant for us accountants, not for investors. We're going to look at stockholders' equity in more detail later in the chapter, but this is just a quick overview while we discuss stocks. In Accounting 1, we learned about owner's equity, which is the amount the owner has invested in the company. When dealing with corporations, we call owner's equity stockholders' equity. Stockholders' equity is comprised of two main parts. First, it is comprised of retained earnings. Just as the name states, it is the company's earnings that remain with the business. It is the net income less any dividends that have been passed out. The more the company earns, the more its retained earnings will increase. Stockholders' equity is also comprised of paid-in capital. This is the amount that was paid in to the company to be a shareholder. Paid-in capital consists of common stock. It also consists of preferred stock, which we will discuss after this topic. What A and B means here is that the stock accounts called common stock and preferred stock are for the par value, as you can see the parentheses below the name. The amount that was given above the par value is called paid-in capital. These are all credit accounts. This sounds confusing, but as we do the journal entries, it will start to make more sense. So let's go over that now. I'm a very step-oriented person, so I like to show you how to journalize using steps. When issuing stock, there are only 3 steps. The first step is to journalize the cash amount received. It is the total the company is receiving for selling the stock. It should be for the market price. When a company receives cash, do you remember if that's a debit or a credit? It would be a debit. Remember that debits increase asset accounts. The second step is to journalize the stock amount given out at par value or the stated value. In the previous slide, I stated that the stock accounts are for the par value and that those were all credit accounts. We credit the common stock account for the amount of the par value. We are not done yet though, because these numbers probably do not match. The amount the company received was probably much, much more than what the par value is. Remember, the par value is sometimes only a penny. Debits and credits need to equal. The final step is to journalize the difference between the market price and par value to the paid-in capital account. You will credit paid-in capital for the difference of the two numbers. For example, the par value of Amazon is 1 penny. If Amazon issues 1 share of stock, the current market price is over $3,000. Wow, this is as of August 2020. I just looked that up and I can't believe how much it has increased during COVID. Anyways, the cash amount that Amazon is receiving is $3,000. The amount that gets journalized to the common stock account would be the par value of 1 penny. The difference would go to the paid-in capital account, which would be $2,999.99. When a stock has no par value or no stated value, then you would not have the paid-in capital account. You would use the full cash amount for cash and the same full amount for common stock. It would only be the first 2 entries, and they would be for the same amount. Let's practice making a few of these journal entries. This is number 1 on your classwork. Remember to download the Microsoft Word document and fill it in as we go. You can also pause this video and try the problems on your own first because it will help you learn better. Number 1, Redco issues 19,000 shares of its common stock for $152,000 cash on February 20th. Prepare journal entries to record this event under the following separate situations. Part A, the stock has a $2 par value. Our first step is to journalize a debit to cash for the full amount it was sold for. We put cash in the debit spot. How much is the company receiving in total for selling all these shares? It would be $152,000. This is listed in the top. Redco issues 19,000 shares of its common stock for $152,000 cash. What is step 2? It would be to credit common stock for the amount of the par value. How much is the par value? It is $2 per share. Do not make the mistake of just putting $2 on this line because there is more than 1 share. It's $2 per share. How many shares are there? There are 19,000 shares being issued. You would multiply $2 by the 19,000 shares. You would arrive at $38,000. The final step is to credit paid-in capital for the difference. You can just subtract $38,000 from $152,000. What amount do you get? You should get $114,000. See, this isn't so bad. Just follow the 3 steps. Part B, the company has neither par nor stated value. In this case, there is no par value, which makes this journal entry a little easier. We still follow the first 2 steps. First, journalize the amount of cash being received. How much cash is received? $152,000. Next, we credit common stock. But we don't do it for the par value because there is no par value. How much do you think we credit the account for? It would be the full $152,000. Part C, the stock has a $5 stated value. This is done very similar to Part A. If you haven't already, you really should pause this video now and try this on your own. Then unpause to see if you are correct or not. What is the first step? Debit cash. How much? The amount of cash being received, which has not changed, so is $152,000. Step 2 is to credit common stock. How much? We have a stated value instead of a par value, but it is done the same way. We multiply the stated value of $5 by the number of shares, which is 19,000 shares. The amount is $95,000. The final step is to credit paid-in capital. You may see paid-in capital in excess of stated value on the homework. The amount is the difference between the market price and the stated value. You can subtract 95,000 from 152,000. You get $57,000. The last point for this topic is issuing stock for assets other than cash or for services. This is pretty common for private companies and for startups. For example, a lot of technology companies will issue shares of stock in lieu of payments to their coders. If the company is not public yet, they can't sell shares on the open market, and they might not have enough cash on hand to pay their employees. So they give them shares of stock instead. Facebook did this. We will look at transactions where stock is issued in exchange for another asset, such as a building, car, or piece of equipment. Since the stock is probably not public yet, we do not have a market price. Instead, we will use the market value of the asset being traded. Use the par value if you can, otherwise we'll use the value of the asset. Any amount over par value will be recorded in the paid-in capital account, just like the previous example. The difference is that we don't have the cash account as a debit since we are not receiving cash. You would replace cash with whatever it is we are receiving. We will practice doing this entry. Number 2, Blue Co. issues 7,000 shares of $7 par value common stock in exchange for land and equipment. The land is valued at $45,000 and the equipment at $85,000. Prepare the journal entry. In this example, what are we receiving instead of cash? We are receiving land and equipment. We list these two items separately because they are two different accounts. We use the value of these items. First, let's list land. We will use its value of $45,000. Then list the next asset, which is equipment. We use its value of $85,000. The remaining two steps are the same as issuing stock. We credit common stock. We use the par value if we have it, which we do. The par value is $7 per share, and there are 7,000 shares. When you multiply, you get $49,000. The last step is a credit to paid-in capital. The amount is still the difference between the debits and credits. 45,000 plus 85,000 is 130,000. The difference between 130,000 and the $49,000 credit would be $81,000.